Hey everybody, after the feedback that I got from a lot of you after the last chapter, some of you said that you liked the fact that the videos were somewhat short. Some of you said you really wish that you could see longer videos. This one's probably going to be a little bit longer video, and you'll understand why here in just a minute. In chapter 2, which is titled Determination of Tax, I kind of translate that into how do you figure out what you're paying taxes on and how much are the taxes. Here's probably the most important part of this video, and that is I want you to understand that chapter 2 is the single most important chapter in your entire book if you're wanting to understand tax accounting. If you flash back and think about whenever you were first learning accounting, whether it was me or one of the other instructors, hit you pretty hard on the fact that there were some basic elements of bookkeeping and accounting that you had to know and understand to be able to go through the entire rest of the semester. What is an asset? What is a liability? What is revenue? What are expenses? What is the accounting, the fundamental accounting equation? That's what this chapter is for this course. This is the basis, the foundation of everything else this semester. And that all starts with what we call the tax formula. Remember, we talked a little bit last chapter about the fact that only individuals and C corporations are taxed. C corporations pay a flat tax rate, and that's covered a little bit in this chapter. I'm not going to do too much of it in this video, although the formulas are basically the same. Individuals, if you'll remember, use what we call a progressive tax structure with different tax brackets that we played around with some examples in the last chapter. Here's something I want you to keep in the front of your mind. This formula that I'm teaching you right now, like I said, is fundamental. It is the equivalent of the fundamental accounting equation whenever we learn bookkeeping. In your book, table 2-1 in the second chapter has this image. This is the formula. This is what we're going to use every single part of the rest of this semester. Print it out, save it, bookmark it, do something, because you're going to be referring back to that a lot. Now, when it comes to this formula, we talked about some parts of it in the last chapter, and most of the chapters for the entire rest of the book, we're going to take different parts of this formula and dig down and get into them much deeper. For this chapter, all I want to do is sort of expand what we talked about last chapter so that you understand it in a little bit more detail. Something to keep in mind is this formula, there's a couple different versions of this formula based on more complicated tax situations. We're not going to worry about that. We're just worrying about the basic formula. And the basic formula starts with what we call total income. For the rest of the semester, most of the time when I'm trying to explain to you how the tax process works, I'm going to talk to you as if it is your own tax return that we're filing. I found that's usually the easiest way for somebody to wrap their head around what's going on and understand is if we were talking about your tax return. So with the tax formula, we're going to start off with all of the income that's being earned. Every source, W-2s, if you earned interest, if you got paid dividends from stocks or bonds that you own, whatever. All of that grouped together is total income. And the government says, we are going to let you deduct out what we call some exclusions from that total income. Now, what are exclusions? Well, basically they're specific types of income that the government's decided that everybody shouldn't really have to pay taxes on. So, like what? Well, here's some examples up on the screen. You'll see that there's more of them. The last bullet that I've got here is that there's another table in your book that I would recommend you looking at. But if you receive proceeds from someone passing away and they had you listed as a beneficiary for life insurance, the government says you shouldn't have to pay income tax on that. Or certain scholarships. Or if you sued someone and you won payments or even received payments, let's say from a workers' comp claim where you were hurt at work, the government says we shouldn't be charging you income tax on that. One that you dealt with a little bit last chapter, you'll deal with it more in the future, is gifts. It's okay for someone to gift you a certain amount of cash. So those are what we call exclusions. So we take total income and we deduct out the exclusions, and that gives us what we call gross income. So that's our first step of the formula. From there, we take gross income and we deduct out what's called adjustments for AGI. And we talked about this a little bit in the last chapter, but let's talk about it a little bit more as far as what they actually are. These are specific expenses that come with earning income. They're costs that taxpayers suffer that they shouldn't be taxed on according to the government. So what are some examples? Well, I've got some up on the board right now. Business expenses. Here's something to keep in mind. All of your income, if you own a business, if you own a sole proprietorship, or you own a part of a partnership, all of the income that comes in for that business would be considered in that first step of this formula, in total income. This, the adjustments for AGI, is where we deduct out the expenses that it takes to run the business. Some other things that come in here: if you contribute to certain IRAs, if you're paying interest on student loans, if you have sold a property and you've lost money on it, then you get to deduct that out of the total income so that you don't have to be paying taxes on it. There's more. Once again, don't forget to check the table for this. But we've got gross income, and right now we are deducting out what's called adjustments for AGI. And that gives us what we call our adjusted gross income, AGI. So we started with total income, we subtracted out exclusions, that gave us gross income. Gross income, we deducted out adjustments for AGI, that gave us our adjusted gross income. So what do we do with that figure? Well, from there, we now deduct out the second type of adjustments, which are called adjustments from AGI. What are those? Well, the U.S. tax law says that the first chunk of your taxable income, we're not going to tax you on. We're going to let you bring in a certain amount of money before you start getting taxed. And what that amount is based on is typically the expenses that a lot of people have. So you get to deduct those typical expenses from your adjusted gross income, your AGI, so that you don't have to pay taxes on it. Now the government says, here's the deal. We're going to let you take these deductions, these adjustments from your AGI. We're going to give you two different ways that you can do it. You can either do what we call a standard deduction or an itemized deduction. And what I want to do right now is take just a second and look at the difference between those two. When we're talking about the difference between standard deduction and itemized deduction, let's look at itemized first. It makes the other one a little bit easier to understand. The government says, here's the deal. If you've got medical expenses that are pretty massive, they're more than 7.5% of your adjusted gross income, we're going to let you deduct those out of your adjusted gross income. Or here's one, to help encourage taxpayers to buy homes, we're going to let you write off the amount of interest that you paid, so that is not taxable on your income tax. If you make charitable donations, if you have losses from what's called a federally declared disaster, you might be living in a hurricane zone, you might be living in a flood zone. If you have losses out of that, you've lost your house, you've lost your car, you've lost all those kind of things, we're not going to make you pay income tax over the lost value of those. They also say that there are certain state and local taxes that we understand that you're paying to the state or local, so we're not going to charge you income tax on top of that. And there's other ones. Now, when we hit this step in the process and we get to this set of deductions, you can go through and calculate each one of those. How much medical expense did I have this year? How much mortgage interest did I have this year? Did I make donations this year, etc.? All of those. Or the government says, if you don't want to go through and itemize all these things, we're just going to let you come up with a flat amount that you can use that you can deduct and not have to show us all the receipts and do all the proof and all the math. And those amounts are based on different filing statuses. Now, the amounts I've got up here are the ones that are currently in place in 2022. I want you to use anything that you see in your book, not the ones that I've necessarily got up on the screen. But right now, if you were filing a single tax return, we're going to let you take $12,950 from your adjusted gross income and not pay taxes on it. If you're filing as married or recently widowed, we're going to basically double that and count it as $25,900 that you don't have to pay taxes on. We'll deduct that out of your AGI. If you're filing as single head of household, and I'll explain what that is later on in the third video of this set, then we're going to let you deduct $19,400. Also, there are some additional amounts. If you've been declared blind, or if you're over the age of 65, we're going to let you have an even bigger chunk that we're not going to. So once again, you can either take the standard deduction, or you can go through and itemize everything and see if that amount actually adds up to be more than what the standard deduction is. So that's the difference between standard deduction and itemized deduction. I've got just a couple more things and then we'll wrap this video and then move on to the next one, which will finish the formula. So we've talked about adjusted gross income. We've now talked about either the standard deduction or the itemized deduction, which is what is considered adjustments from AGI. Once we deduct that from our AGI, we have what's called taxable income. Taxable income is all the money you earned, minus the exclusions, minus the deductions for AGI, business expenses, that kind of stuff, minus deductions from AGI, either the standard deduction or the itemized deduction. The other thing to keep in mind is that taxable income is also the amount you use to calculate the amount of taxes owed. Okay, so that's it for the first of the 3 videos. The other 2 are a little bit shorter than this. That's the first part of the formula. We've started with total income and we've worked it down to our taxable income. Take a break, take a breather, then come back and watch the next video where we'll talk about, okay, we've got that taxable income figure, what do we do with it? I'll see you over there.